Well, the dollar dropped this morning when the minutes of this month's Reserve Bank board meeting came out, but it's hard to figure out why. The minutes didn't add to the sum of knowledge on top of the statement that came out after the meeting, which itself didn't tell us anything new either. I guess the dollar fell because it wants to, and there was nothing in the minutes to stop it. In fact, after a 5-cent rally in April and a small upward blip in June, the currency has now hopped back onto its train tracks. If it stays on this train, it'll be around 65 US cents by the end of this year. That's not a prediction, I hasten to add, merely an observation. The share market has now gone up 6 days in a row for a total rise of 4.2% over those 6 days, which is probably at least partly due to the resumption of the dollar's decline, since so many companies benefit from a devaluation of the currency. Not a lot of highlights today. The banks were mixed. CBA down, the rest up. Medibank Private had a strongish gain, but engineering firm Bradken continued to be beaten up by the market, down an almost 10% today. It's lost about 70% of its value since January. Global markets mostly rose, including a rise of 1% on what's left of the Shanghai market. Gold fell again to below $1,100 an ounce this time. Iron ore went up, but oil and wheat fell. And finally, a couple of property graphs to finish. This one shows foreign investment in properties in Melbourne and Sydney as a proportion of total demand. And the foreigners are getting out. In Melbourne, the share has halved, and in Sydney, it's almost halved. And last but not least, Greek house prices, down 40%. It's all bad there. And that's finance.